The greatest peril within any economic bubble doesn't arrive during its collapse. It emerges precisely when uncertainty vanishes. This occurs as values climb, conviction appears warranted, and caution begins to seem foolish, not careless, not imprudent, simply obsolete. Onset the term bubble becomes part of common discourse. The critical damage has occurred not through deception or scheming, but through the human psyche gradually persuading itself that circumstances have fundamentally changed. Welcome to the financial timeline. Wealth, influence, and the past intersect, and nothing is quite what it appears. The nature of bubbles. Each significant economic bubble throughout history possesses an unusual characteristic. During its formation, it never appears illogical. It appears sensible, even proven. Those involved don't think they're gambling. They think they're adjusting to emerging circumstances. This explains why bubbles prove so difficult to identify from within. They don't declare themselves as they announce themselves as advancement. This dynamic isn't contemporary. It's timeless. Long before electronic trading and startup funding, people were creating speculative frenzies around assets that appeared to offer a dramatically altered future. Tulip bulbs, in 17th century Holland, represented more than botanical specimens. They symbolized prestige, scarcity, and an innovative market framework. Railways in the 19th century signified more than iron and locomotives. They embodied national ambition. Broadcasting company shares in the 1920s represented more than businesses. They captured the resonance of tomorrow. The digital revolution in the 1990s signified more than computing. It represented the elimination of geographical barriers. Each innovation held genuine substance. This matters. Bubbles don't emerge from fantasy. They emerge from reality, extended past its sustainable limits. The psychological mechanisms, the mental processes driving this phenomenon, remain remarkably uniform, beginning with something profoundly human, our requirement for narratives. People don't comprehend the world through data tables. We comprehend it through stories. A narrative clarifies causation. It provides significance. It diminishes ambiguity. When a persuasive narrative connects with an emerging technology or asset, it gains tremendous force. The figures don't drive the conviction drives the figures. After a narrative establishes itself, valuation ceases being the foundation. It becomes secondary. Conventional measurements are dismissed as outdated, remnants of a reality that no longer applies. Profitability isn't rejected completely, it's deferred. Deficits aren't perceived as alerts, they're characterized as expenditures towards certain supremacy. When a narrative feels sufficiently authentic, mathematics becomes bothersome. Social dynamics and confirmation. This marks the entrance of social validation. Within uncertain conditions, people naturally observe their peers. When others are purchasing, buying feels safer. When esteemed colleagues express confidence, hesitation begins feeling superfluous. Markets magnify this tendency because ascending prices themselves constitute proof. Each valuation increase strengthens the conviction that the narrative must be accurate. Otherwise, why would numerous people concur? Eventually, doubt becomes socially costly. Researchers questioning valuations are termed cynics. Participants remaining uninvolved feel excluded. Professional jeopardy begins exceeding monetary jeopardy. It becomes simpler to err alongside the majority than succeed in isolation. Agreement doesn't resemble mob mentality when you're experiencing it. It resembles verification. After agreement develops, confirmation bias dominates. Participants don't cease examining information, they simply cease examining inconvenient information. Favorable indicators are emphasized, distributed, and reiterated. Unfavorable measurements are reinterpreted, contextualized, or rejected as irrelevance. Valuation frameworks are modified. Standards are relaxed. Terms like temporary, transitional, and long-term begin performing significant work. This represents the stage where bubbles become self-reinforcing. Any evidence contradicting the prevailing narrative gets interpreted not as caution, but as proof that the skeptic simply fails to grasp the emerging framework. Overconfidence in authority. Then arrives overconfidence, the subtle variety. Ascending markets reward involvement. Initial success feels earned. Profits are credited to perception, execution, and acumen rather than circumstances. Inexperienced participants believe they've identified a special opportunity. Veteran participants believe they've mastered risk management more effectively this iteration. Everyone believes they'll withdraw before the downfall, despite history demonstrating almost nobody does. Fortune feels identical to brilliance until it stops. Authority bias provides the ultimate layer of psychological protection. When prominent institutions endorse the narrative through involvement, hesitation vanishes entirely. Large financial firms publish optimistic and governments praise innovation. Central authorities sustain accommodating policies. Capital circulates freely. At this juncture, the asset ceases feeling speculative. It begins feeling sanctioned. Nothing indicates secure system quite like requiring institutional validation to preserve confidence. The cruel reality. Here's the harsh truth. None of this feels imprudent during its occurrence. It feels like convergence, like advancement, like destiny. Values climb. Conviction strengthens. And prudence diminishes not because people cease reasoning, but because reasoning becomes emotionally troublesome. This explains why bubbles are so infrequently acknowledged in the moment. They don't feel like insanity. They feel like agreement catching up to circumstances. Yet agreement possesses a weakness. It cannot perceive the premise supporting everything. Once a bubble becomes apparent, it already feels ordinary. That's the contradiction. The psychology generating bubbles doesn't announce surplus, it numbs it. Ascending values cease feeling like an indicator and begin feeling like ambient condition. Fluctuation becomes routine. Danger becomes theoretical. Eventually, the inquiry ceases being, "Is this maintainable?" and becomes, "How do I prevent being excluded?" Modern manifestations. This distinguishes contemporary bubbles from the stereotype we envision. They don't demand widespread frenzy. They don't require retail traders abandoning their occupations or service workers dispensing investment advice. Currently, bubbles can develop quietly, propelled by institutions, indices, and capital accumulation with minimal active questioning of fundamental premises. This leads us to the present moment. Presently, an increasing number of participants are questioning whether we're observing the initial phases of an artificial intelligence bubble. Not because AI is fabricated, it isn't, but because anticipations surrounding it are expanding more rapidly than the fundamental economics can presently support. This differentiation matters. Every major bubble throughout history was constructed on something authentic. Railways revolutionized transit. Electrical power restructured manufacturing. The internet altered communication permanently. The dot-com bubble didn't collapse because the internet was worthless. It collapsed because capital presumed immediate, comprehensive, and flawlessly profitable implementation. AI follows the identical pattern. The technology is authentic. The efficiency improvements are authentic. The lasting influence is probably substantial. However, markets don't value lasting inevitability. They value near-term anticipations. That's where psychology re-enters the calculation. Current AI investment landscape in recent periods, a limited collection of AI-associated companies, has generated a disproportionate portion of aggregate market increases. Index results have become progressively concentrated, signifying fewer entities are accountable for most appreciation. This concentration alone isn't evidence of a bubble, but it represents a recognizable component. When conviction channels capital into a restricted set of representations, those representations begin carrying narrative significance, far exceeding their financial records. Valuations climb not solely because of forecasted revenues, but because of presumed supremacy. Margins that don't currently exist are valued as though they're certain. Substantial capital spending is recharacterized as strategic. Profitability becomes something that will materialize subsequently after expansion, after market dominance, after disruption completes rewriting the framework. Does this sound recognizable? This marks where confirmation bias quietly performs its function. Favorable declarations are magnified. Implementation announcements are commemorated. Unfavorable data elements escalating expenses, competitive tension, regulatory obstacles. It's rejected as myopic thinking. Simultaneously, authority bias reinforces the narrative. When significant funds, index administrators, and institutions allocate substantially toward the identical theme, conviction solidifies. Involvement itself becomes endorsement. The inquiry ceases being "what is this valued at?" and becomes "how committed am I?" If this continues ascending, this represents the psychological transformation that characterizes the advanced phase of conviction formation. Not alarm, not frenzy, simply quiet convergence, the uncomfortable truth. Here's the disquieting reality. None of this demands malicious intent. Most participants aren't reckless. They're logical, reacting to motivations, standards, and professional jeopardy. When underachievement carries occupational repercussions, remaining conservative becomes more perilous than remaining committed. This explains how bubbles can expand without widespread excitement. They don't require enthusiasm. They require conformity. The error people commit is presuming bubbles collapse because everyone abruptly recognizes they were mistaken. That almost never occurs. Bubbles collapse because one premise fractures. It might be income expansion. It might be expenses climbing more rapidly than anticipated. It might be an adjustment in borrowing costs that compels capital to reassess danger. Whatever it is, the instant the fundamental narrative loses consistency, psychology inverts trajectory. Conviction doesn't diminish progressively. It fractures. When it does, the identical forces that propelled values upward hasten the descent. Social validation inverts. Confirmation bias searches for negative information. Overconfidence evaporates. Authority withdraws. Liquidity disappears. What previously felt inevitable abruptly feels precarious. This explains why bubbles feel unmistakable in retrospect and invisible in the moment. Protection and self-awareness. How do you safeguard yourself? Not by forecasting collapses. History demonstrates that timing bubbles is virtually impossible. The objective isn't prediction itself. The most critical question is not, is this a bubble? It's, what conviction am I depending on? If expansion decelerates, what fractures? If capital restricts, what transforms? If anticipations adjust, what endures? When investment choices are anchored to narratives rather than monetary flows, chronology matters. When valuations depend on future flawlessness, patience becomes jeopardy. When everyone surrounding you feels assured, that's when ambiguity deserves the greatest consideration. History doesn't recur because assets transform. It recurs because psychology doesn't. Bubbles don't develop because people are acquisitive or foolish. They develop because conviction feels safer than hesitation, right? Up until it stops, the people who endure them aren't the ones who perceive the future distinctly. They're the ones who comprehended their own premises. That's the authentic lesson concealed beneath every collapse diagram and retrospective article. If this provided you a fresh viewpoint, hit subscribe. History contains the solutions. I'll demonstrate where to search.